This program is brought to you by the National Association of Insurance and Financial Advisors, promoting political advocacy, education, and the ethical conduct of its members nationwide.
Hello, I'm Colleen Rideout with Security One Lending. I'm here today at NAFA headquarters to present for you a program in a box. This program in a box is specifically using home equity in retirement. And I want to give kudos to my partner Steve Thomas from Colorado. He is the instructor for the long-term care classes. About a year ago, Steve Thomas and I hooked up. In Colorado, the Commission requires that there be a section in both the 8-hour initial long-term care class as well as the 5-hour long-term care class on home equity. And Steve got a hold of me about a year ago and said, let's do this right. Let's teach it the way it should be taught. And so we took a program that was developed by some very, very good people at Security One Lending, and we customized this for this 1-hour presentation specifically for NAFA members. So I hope that at some point all of you during this presentation will have the aha moment where you say, I didn't know that. What I want you to understand is that it is better to plan an income strategy than to react when the customer is up against a wall. So this is how Steve would introduce this program, and thank you, Steve. If what you thought to be true about reverse mortgages proved not to be true, when would you like me to tell you? Well, let's go forward. First of all, let's talk about the rules of the road. This is the disclaimer. These strategies are designed not for the purchase of investments. They are designed to maximize investments. You'll see on the screen, this is the way you are already working with your customers. This is nothing new to you. But we always have the disclaimer right up front. Not for the purchase. It's important to know at this point that October 1st of 2013, FHA completely redesigned the HECM program. As a result, an organization that's very near and dear to all your hearts, FINRA, changed their position about reverse mortgage. They used to have the position that reverse mortgage is only a product of last resort. Not anymore. Here is the FINRA position statement that they released at the end of the month, last October, in reaction to the new HECM product. Make informed decisions when using the reverse mortgage. But they've backed away from the position of this is only a product of last resort. Important to know. I've even put the reference information there if you want to check this statement out on the FINRA website. It's right there. What are we going to talk about today? Why is this important? Why does it matter? We're going to talk about how the reverse mortgage works. I'm going to teach you. And I need to tell you up front, I'm Italian, and I use my hands. So I'm going to show you with my hands how this works. It's the easiest way for me. We're going to talk about some case studies at the end, and we're going to come to some conclusions. But it's very important that you see that bottom line on this screen. My greatest fear is outliving my money. Richard Rust, my mentor. Who is that? That's my dad. That's my father. And he has said that to me since I was very young. My greatest fear is outliving my money. And he is no different than any of you or any of your clients. That they fear outliving their money more than they fear death. Hard to believe. When we started putting this program together, I went to the internet to find I needed an image for a stool. And it's amazing if you go to the internet how many different industries use a stool as a stability example in their industry. I will warn you that if you try to do this, do not call this the stool example. It doesn't read well. It just doesn't read well. This is the retirement stool. So generally speaking, Social Security is the primary leg for many of your clients. Not the more affluent, but for many clients, Social Security is the main leg of that stool. We've talked about that income from Social Security. The other sources are defined retirement plans and non-qualified savings and investments. What we want to do is add more stability to that stool. We want to add home equity. And the reason we want to add home equity is because if we have more choices, if we have more options, we can make better choices, personally and for our clients. So let's talk about what the new HECM has done for us. It has really moved to the forefront using a HECM, a home equity retirement mortgage, a reverse mortgage, in retirement income planning, rather than a product of last resort. We used to only suggest to our clients, you better look at a reverse mortgage when they're completely out of money. But what I'm going to show you today is that if we pull that forward into the planning process, how much better that retirement plan's going to work. It's better to plan a retirement income strategy, not to react to it. Because this is an FHA insured loan, I need to make sure that everybody understands how FHA mortgages work. This will always be an example of what we call a traditional or forward mortgage. All the examples for a reverse mortgage are going to be here. So whether or not a young borrower is doing a first-time home purchase with 3% down and doing a traditional FHA forward mortgage, there are mortgage insurance premiums charged in two ways. The first is up front. The second is on the back end. What does that mean? What do you mean by the back end, Colleen? When you get an FHA traditional mortgage, you make payments, principal, interest, taxes, and insurance, mortgage insurance, PITIM. The reverse mortgage is the same. Upfront mortgage insurance and back-end mortgage insurance. And I'm going to show you how that works, but I want you to understand that there are two types of mortgage insurance premium always with an FHA loan. That's part of the program. What this allows seniors to do is to convert that home equity into cash. And one of Steve's favorite things to talk about is that home equity is illiquid. Home equity you can't use in retirement unless you free it up. The important thing to know about this is that it's tax-free. This is not income. These are loan proceeds. And loan proceeds are not taxable. Now I want you to start thinking, oh, so when we look at choosing which pot of money we want to take from, remember that when you're pulling from your home equity loan, your reverse mortgage home equity loan, tax-free money. This is for borrowers who are 62 years of age or older. FHA is currently working on a plan to allow spouses that are younger than 62 to be able to be on a reverse mortgage. There's going to be some changes. This is in the works. It's not out yet. But we will be able to do that if both borrowers are not 62. And for our purposes today, I want you to think about 50% of the value of the home will be available in a reverse mortgage. Contrary to popular belief, people think that when they do a reverse mortgage, when I get the phone call that says, Colleen, we want to do a reverse mortgage and we want to use the whole value of our house. No. And I'll show you why it works that way. But think about 50% of the equity can be accessed through a reverse mortgage. This is pretty important. It has to be your primary residence. You can only do a reverse mortgage on your primary residence, but it can be 1 to 4 family. Primary single-family residential is actually defined in the mortgage business as 1 to 4 family. It must be owner-occupied. Now, once again, might get your wheels spinning and say, okay, 1 to 4 family, so long as the client lives in one of the units, they can rent the other unit. So you can talk about a duplex, a triplex, a fourplex, with additional income coming from the other units. I always tell my people, if it weren't for misinformation about reverse mortgage in the marketplace, there'd be no information at all. So let's dispel some of the myths right now. And the first one is, oh, if I do a reverse mortgage, I have to give title to the bank, to the lender. I own a condominium. I have a mortgage on that condominium. I am entitled to my condo subject to the balance of the loan. If I die, title passes into my estate subject to the balance of that mortgage, and my son has to come and deal with that. He'll have to sell my condo and pay off the existing mortgage and keep the equity. Reverse mortgages are exactly the same. Our borrowers are entitled subject to the balance of their loan. When they die, title passes into their estate, and then the estate looks at what is the balance on that reverse mortgage. And I'm going to show you how those balances can vary dramatically from loan to loan, depending upon how the clients want to use their money. They stay entitled. Number 2, who gets the remaining equity? We just talked about that. The estate gets the remaining equity, or whoever is named, however this is taken care of, either in a will or a trust, the remaining equity goes to that beneficiary. When does the reverse mortgage come due? This is really kind of an interesting thing, because one of the things that seniors even still today express to me is that, what if we outlive the reverse mortgage? Congress took care of that in the original act in 1988, and borrowers can stay in the home regardless of what happens to the property value or the balance of the reverse mortgage until the youngest borrower turns 150. And it's interesting because actually in the deed of trust, in Colorado, we're a deed of trust state. The deed of trust actually, because it's a contract, has to have an end date, has the youngest borrower's 150th birthday, and their eyes just pop. Congress did that to assuage the fears of any borrowers that they might have to move out. Okay? Does the property have to be free and clear? That's a myth I hear all the time. Well, we can't look at a reverse mortgage because we have a loan on the house already. Well, this is going to be one of the strategies, one of the case studies that we're going to do today. As long as the balance of that existing mortgage can be paid with the proceeds of a reverse mortgage, you can do that. And that is a strategy, is to get rid of that mortgage payment. Last I heard, the closing costs are really high. I started as a reverse mortgage rep in 2007, and the program was the same as it is now, but the fees were higher, and I'm going to show you. In the examples we're going to use today, we're going to use a $500,000 house. That's average across the country. We have two coasts and we have the center of the country. Home prices are generally a little lower in the center, but they're higher on the coast. So we're going to use a $500,000 example consistently through our case studies. So in 2007, let's say I'm going to write the same $500,000 loan, and we use the property value as the loan amount. So you'll hear me use those terms interchangeably, and that's why. So in 2007, if I had a $500,000 house, here are the closing costs. There's a 2% loan origination fee, $10,000. Cha-ching! $10,000, $2,000. There was a 2% mortgage insurance premium, $10,000. Cha-ching! We're up to $20,000. There was also approximately a $5,000 servicing fee that was profit to the lender. Due to competition, that servicing fee is gone. Now we're up to $25,000 plus closing costs. Title insurance, appraisal, closing fees, recording fees, normal closing costs that are associated with any loan. That $500,000 loan cost about $28,000, give or take, in 2007. Today, because of the changes in FHA, those fees have changed dramatically. And here you go. No more servicing fee. Pre-2013 and now. No servicing fee. Gone. Loan origination fee. Gone on a par rate. And by par rate, it's important to me that you understand this par rate thing. If you call your mortgage lender, let's say you get instructions from headquarters that says, check and see what rates are today, honey, and let's see if we might be able to refinance the loan and get a better rate. If you call your mortgage lender, they're going to say, and I'm just going to use examples, you can do 5% today with no discount points. At 4.75, we're going to charge you a point. At 4.5, 2. At 4 1/4, 3 discount points. So you understand the concept, really, of buying down an interest rate. So the par rate here is 5. There's no discount points. In our example, for a reverse mortgage, there's no loan origination fee on a par rate. There are always the options to buy that thing down, but we're going to deal with par. Don't want to talk about those extra fees. So no loan origination fee today. The closing costs are still the same, give or take $3,000, depending upon your location. I'm referring to Colorado, so you're in different states. Your closing fees are going to be a little bit different. Upfront mortgage insurance premium. Big change with the new HECM in 2013, October 1st. It used to be across the board a 2% upfront mortgage insurance premium. They changed it because what was happening is that borrowers were applying for a reverse mortgage and they were able to take their proceeds either in a line of credit, which I'm going to explain to you, or they could take a lump sum. There are different distributions, which I'll show you. But when they took a lump sum, what happened was we found that they were spending the money. I will tell you that what I'm finding and what I'm seeing in the people that I talk to, people who are young and financially irresponsible, when they become seniors, they don't always become more financially irresponsible. So what happened was that people took a lump sum and they spent it and used it all. This is where FHA said, we don't want to do that anymore. What we want to do is encourage borrowers to use the funds slowly, prudently, so that it would last longer. So what they did, if you look at this slide, you'll see that if borrowers have to take a lump sum, and I'll show you reasons to take a lump sum for a purchase, for example. If they take a lump sum, 2.5% upfront mortgage insurance premium, if they're going to use it slowly, prudently, 0.5% mortgage insurance premium. So we were looking at 2% upfront MIP in 07. Today we're looking at a half. So instead of $10,000, we're looking at $2,500. So the examples that we're going to use today on this $500,000 house are going to have closing costs of $5,770. That's just the calculation. So compare $28,000 back in 07, today $5,700. Totally different product. So now you think, oh no, now you're starting to get my attention, Colleen. The closing cost, it's not as expensive as I thought it was. So let's talk about how a reverse mortgage works. When you get a forward loan, you get the money and you make regular payments back on that loan. Because you're making regular payments back on that loan, that mortgage balance is declining. What's it called? Fully amortizing. But because you have to make payments on that loan, it's fully qualifying. On a forward loan, we have to verify income, assets, credit. And for seniors on a fixed income, the qualifying is difficult. That's the purpose of this product. Let's look at a reverse mortgage on this hand. With a reverse mortgage, you get a loan, but you don't have to make payments. Because no payments on a reverse mortgage are required, there's also no qualifying. We pull a credit report to verify that there are no outstanding debts to the government. If there are tax liens or property tax liens, income tax liens, those have to be paid as part of the transaction. But other than that, there's today no qualifying. So you say, okay, wait a minute, how does this work? What happens to the interest that's not being paid on the forward side? That interest accrues to the balance on a reverse mortgage. What's it called? Negatively amortizing. It's one of the only negative AM loans left in the United States, the HECM FHA reverse mortgage. So, because that balance is growing, that's the reason for the 50% loan to value, give or take. And that loan to value goes up when people are older. So if I have a 90-year-old borrower, they're going to get higher than 50%. It's simply actuarial. They're not going to live as long, so they get more money. All right, next. Non-qualifying, just talked about that. Because no payments are required, and I say required because you can make payments. I'll illustrate that for you. We don't have to qualify these seniors. The only qualifying we need to do is if it's a purchase. I have to verify where my borrower's down payment is coming from. And there's lots of ways to do that. Sometimes it's from the sale of a departure home. Sometimes it's a gift from the kids. We can do those things. But we do have to verify down payment. That's the only thing we do is for a purchase. Now, this is important. Do y'all understand non-recourse? On a forward mortgage, in 2008, 9, 10, 11, we experienced the highest foreclosure rate in the country. It was terrible. Many borrowers, through no fault of their own, maybe they lost their job, maybe they got sick and they couldn't work anymore, and they were in a house that they could no longer afford. So what happened to all those houses? They went back to the lenders in foreclosure. What happens in that foreclosure process? Well, if the house, let's say they had a $400,000 house, and in 05, in 04, 05, you just had to be able to breathe to get 100% loan to value. So they purchased this house, $400,000, and in 08, what happened to the property values? Started to tank. Across the board in Colorado, we experienced about a 35% depreciation in property values. Some areas in the country did much worse, some a little better, but 25 to 30% was pretty average. So they give that house back to the lender in foreclosure, and what happens? The lender remarkets the property, generally for less than the surrounding properties. So it does terrible things to the neighborhood when we have a lot of foreclosures in a given neighborhood. It just ruins property values. So now they sell it for less than is owed. They have attorney's fees. They have penalties and interest that have accrued. And what does that all equal? A deficiency balance. What happens to that deficiency balance? The lender files a deficiency judgment against those borrowers that follows them past death. It will follow into their estate. So that estate, in order to settle, will have to attempt to pay that deficiency judgment from that foreclosure. That's the forward. Let's look at the reverse. This is a non-recourse loan. Because it is an FHA, federally insured loan, it's non-recourse. So what does that mean? If the borrowers take the money, and we know that that balance is going to rise depending upon how they use the money, what happens if even property values fall again and there's a deficiency? What happens is the estate goes in and they look at the property and they say, well, this property, we owe $450,000 on the property, but now the property's only worth $400,000. We're upside down. What do? They pick up the phone, they call the lender, and they say, thank you so much for making mom and dad's senior years really much better. They got to keep their independence, they got to continue to live their lifestyle, but now we owe more than the property's worth. Do you want us to lock it up or mail you the key? What happens in that estate is those people get to settle the estate without dealing with the property. What happens? The lender deals with the property. We remarket the property, and what happens to the deficiency? We go to the FHA mortgage insurance premium pool, where all those premiums from all those FHA loans are deposited, and FHA insurance pays that deficiency. So remember that you can settle the estate without dealing with the house. Well, but wait a second. You're just saying we're giving the house back. What happens if the house is worth $500,000? Mom and dad die. Kids look at the estate and they say, oh, okay, house is worth $500, we owe $250. What do? If one of them wants to buy it, if someone in the estate wants to buy the house, they need to pay off the existing loan, same as a regular loan. Or they put the property on the market, they sell it, they pay off the existing mortgage, they settle the estate, and everybody's happy. So big difference there. Non-recourse, very important. No defined term, we already talked about that, until the youngest borrower is 150 years old. So how are these funds dispersed? We need to talk about a line of credit. So once again, I'm going to do a comparison for you. On a traditional line of credit, you might go into your lender, Bank of America, Chase, Citi, Wells, your lender, your bank, and you say, I want a home equity line of credit, $50,000. I want $50,000 in a home equity line of credit so I can use that and make my own financial decision. If you take money out of the line of credit, you have to make payments. If you don't take money, no payments are required. However, at the end of year 1, how much credit is available on that line? $50,000. At the end of year 2, how much credit is available? $50,000. But not on a reverse line of credit. We have a growth factor. Because what happens on a reverse mortgage is the initial distribution amount, the amount that's available to the borrowers, we give a future value to, and that's what this growth factor is all about. What happens, we've talked about the interest rate. Most of our reverse mortgages are adjustable rate mortgages. They're tied to the LIBOR. The London Interbank Offered Rate is the standard in the ARM business, in lending. So it's the LIBOR plus a margin. The par margin is 3%, so there's no loan origination fee. The LIBOR today is 0.156. So the initial rate is 3.156. So what's the growth factor today from the beginning on that line of credit, the funds that are released into the reverse mortgage HELOC? The growth factor is the interest rate of 3.156 plus 125. That's the back-end mortgage insurance. So interest rate plus back-end mortgage insurance equals the growth rate on the line. So if we start a line with $50,000, then the next year that line's going to be worth $53,000. And the following year it's going to be worth $57,000. Now remember, this is an adjustable rate mortgage, so the rates can vary. Rates might go up. Wait until you see that illustration. So you understand a revolving line of credit with a growth factor, okay? Works just like a HELOC. I want to make sure here you also understand that this is a revolving HELOC. You don't just have the ability to take money out. You can use it and pay money back. You can use it the same way as a traditional bank HELOC. Here's another example. Monthly payments. You can take monthly payments from that line. That's available. You can take it all at once. If you decide you want to take out all the money in that line of credit, you can do it. Any combination of the above, we're going to show how you can mix this up a little bit. You can customize this loan to fit exactly the needs of your client. It's amazing. I'm going to show you how to do it. And here's the beauty. This loan, the distribution of this loan, can be changed with a $20 fee. So if you have all of your money in a line of credit and you want to get regular monthly payments out, $20 fee, you'll start getting monthly payments. If you're getting monthly payments and you want to stop them, $20 fee, and you can put it all back in the line of credit. You can do whatever you want with this. Here we go. FHA has built into this program some safeguards for the borrowers. When they did a lot of homework, and they did it right in '88 when they introduced this product. Let's look at these safeguards. This is a non-recourse loan. No deficiency judgment can ever be filed against the borrower or the borrower's estate. We understand that the lender will go for the deficiency to the FHA mortgage insurance premium pool. We know that the homeowner stays in title. We know that the estate gets the remaining equity. The borrowers can stay there permanently. They're not required to make P&I payments. There is mandatory third-party counseling, and there is a reason for that. Because this product is so different, the federal government says we're not going to let anyone make an application for a reverse mortgage until they've completed counseling with a HUD-certified counselor. And there are hundreds of them available across the country. It's about an hour-long training, and it's going to be basically the same thing that I'm teaching you today. Basically the same training. Growing equity line that cannot be canceled, frozen, or reduced. Once a line of credit is established, once a reverse mortgage is closed and in place, the terms of that mortgage can't be changed. Why is this important? How many of you had lines of credit in '08? I did. I had a home equity line of credit just sitting there. I felt safe knowing that I had some money. If I needed it, I could make myself a loan. But what happened when the federal government, this was pre-Frank Dodd, what happened when the federal government started looking at all the lenders? They said, you're undercapitalized. You've got commitments for outstanding loans that you don't have reserves to cover. So what was their immediate reaction? They canceled all those lines of credit. I got the lovely letter that said, thanks for playing. No more line of credit. Gone. That reduced their capital requirements. This HELOC cannot be canceled, frozen, or adjusted. And that line of credit, those funds will grow regardless of what happens to the property value. It is contractual and it cannot be changed. It is not tied to property value. Once the initial appraisal is done, that's it. Let's see why we're really here. We've got some problems today. The bottom line is we're just living too long. We are just simply living too long. And I'm going to go back to my dad. And on his 84th birthday, he lives in Cheyenne, Wyoming. On his 84th birthday, we went for a birthday party. And he says, Colleen, we need to talk. Okay. Let's go to the patio. Let's pour a drink. Because in Wyoming, you have a Jack Daniels. If you're going to have a serious conversation, you're going to have a Jack Daniels with that conversation. So we took our Jack Daniels and we went to the patio, and I was really frightened. I thought he was going to tell me he had terminal cancer or something. And he says, Colleen, I have to be dead in a year. I said, what do you mean you have to be dead in a year? He says, my financial advisor, when we put my plan together, only planned for me to live to be 85. And that's traditionally how financial advisors worked. 85 was generally enough. Not anymore. Somebody's going to live to, one of those people's going to live to be 90, a 25% chance. One of them may live to be 100. Here's the second problem. The blue line on the column on the left, you're going to see some age brackets where we've broken this down. The blue line represents total assets of the average borrowers within that age group. Total assets. The green line represents cash, investments. I'll do a quick calculation for you. It's about 25%. How in the world are we going to plan a successful retirement for couples who are going to live, one of them's going to live to be 90, only using 25% of their assets? We need to open our minds and figure out how to use all of the assets to make this last. I will throw something else in here. I'm a baby boomer, so if I make any disparaging remarks about baby boomers, I is one. And most of my friends are baby boomers. And I will tell you that in this slide, this represents defined pension plans, defined contribution versus defined benefits. Defined benefits are pension plans. The old pension, they're not old, but there aren't as many as there used to be. So the blue line, in 1975, Congress passed the law that allowed us to save money in a 401k, tax deferred. So what happened was pension plans went away for the most part. And people were left now to plan for their own retirement. What happened? I can tell you that a lot of the people I know never really got it, that they had to save for their own retirement. What was this all about? This is a risk shift. So we shifted the risk from the employer to the employee. And we all know that a lot of people just didn't get on board, didn't start playing. I want to back up for 1 second. In this slide, during the worst of the financial crisis, the recent financial crisis, a full 68% of seniors owned their homes free and clear. So we didn't have a lot of mortgages on that total asset. They owned them free and clear, even through the financial crisis. And back to this slide, we know that risk has been transferred from the employer to the employee, and a lot of people just didn't get on board. They didn't climb on board. So, how do you use a reverse mortgage? Let's talk about this. Here's some strategies. In your business, do y'all talk about tools in your toolbox? I mean, you're going to hear, speakers will talk about what are the tools in your toolbox. I will tell you that the line of credit with a growth factor for me is my hammer. That's the hammer in my toolbox. I'm going to give you examples of how all of these work. I'm going to show you how to use a reverse mortgage for supplemental income, how to eliminate a monthly payment, and I'm going to teach you how to do HECM for purchase. We're going to use the $500,000 home in all of these examples. We have Mr. Borrower who is age 66. He needs $72,000 a year. This guy has money. He's got $750,000 in his 401k. He's got some cash, and his Social Security income is $25,571. What does that tell me? It's probably 2 Social Security incomes. Not enough to live on. Back to the 41%, replacing 41% of our pre-retirement income. Here's what that looks like. And here we got the home value of $500,000. I need to, before I move to the next slide, I have to explain one more concept to you. We talked about how an ARM is calculated. Index plus margin equals the rate. We know that the index is the 1-month LIBOR. We know that the par margin is 3.0, so the rate 3.156. However, we're under no illusions, neither is the FHA, that initial rate will be the rate throughout the life of that loan. So what the FHA does, and it's through their very sophisticated computer programs and an algorithmic formula, and I'm convinced that there's a dartboard and some darts involved in this discussion at some point, because how do you know? But bottom line is, we use what's called an expected rate. The expected rate is not the 3.156. It's the rate that FHA believes, that the market believes that loan, the rate will be over the life of that loan. So let's look at what happens to this 66-year-old borrower if we do a reverse mortgage for him. Remember, the closing costs are $5,770. So those come out of the first draw. They come out at closing. That's not cash from your borrowers. They don't need to come to closing with this money. It's a draw from the loan. So if you look at this, it will show you that we start the line of credit with $222,000. At the end of the first year, that line of credit is $238,000. This is on an expected rate of 5.8 plus 1.25, because those two numbers together equal the growth factor. I want you to look at this. I want it to sink in. At the end of 10 years, based upon an expected rate of 5.8, and we all know that rates will not stay this low forever, where we are today, that line of credit has a value of $450,000. What happens at the end of 20 years? Almost $1 million. $913,000 in 20 years. Now, there's some points to be made about this. So what happens to the borrowers who say to me, oh, you know, Colleen, we don't really want to do a reverse mortgage now. We want to wait and do it later, which says to me, we want to wait until we're really in trouble and we need it. We don't want to look at it today. We don't need it today. What happens to those people? What if they wait 10 years to come back to me and say, Colleen, now we're kind of, now we need a reverse mortgage. What happens? In 10 years, instead of having $450,000 available in that line of credit, we start with $222,000 if the program is still available. There's no guarantees. We have no guarantees that this FHA reverse mortgage is going to last into perpetuity. Just isn't there. So they come back to me in 10 years, and now we can give them the 222, provided the program's available. We don't have the benefit of the years. So when I was in mortgage banking school, the saying that they always said, it's not timing, it's not your timing in the market that makes you money, it's time in the market. So this is the example. If you do it now rather than later, you've got the advantage of time. Now I want to pick on a financial advisor in your group and ask you, Mr. Financial Advisor or Miss Financial Advisor, where can you take $5,770 from your client and with some assurance give them $450,000 in 10 years or $1 million in 20 years? Where can you do that? Most people, when we're doing this class live, say, well, it's red and black and it's generally done in Nevada, but there really isn't another way to do that. And remember that this is federally insured. This isn't pie in the sky. This is federally insured. So, line of credit. We may come back, there may be some questions about this, but this line of credit is extremely important. It gives the ability to any borrower, whether the house is paid in full, they can set up for years later when they're going to need some money. What are those examples? If I do this when a borrower's in their 60s, and to a person, except for borrowers who already have some health problems, none of them think about so they're 62 now, what's going to happen to me when I'm 82? What are my needs going to be when I'm 82? They're going to be completely different than they are at 62. They might want to use some of this money to purchase long-term care insurance, which is why it's included in the long-term care classes, this home equity portion. They may need to make their home handicap accessible. One of them might be in a wheelchair. Another example that I see a lot of is they need to help their children for sometimes good reasons, sometimes not so good reasons. They need to be able to help their children or their grandchildren. Here's the pot of money that when they're 82, instead of having $200,000 available from their home equity, now we've got almost $1 million. Very important, very important. So let's talk about, I just want to do a recap here. I'm not going to read it to you. Let's look at the differences that we've already gone over between a home equity conversion mortgage line of credit versus a traditional HELOC. The only thing is that's the same is that you can take the money and use it in a variety of ways. Here's where all the changes, here's where all the advantages fall in the HECM, in the reverse. No credit score, no income, no monthly payments. The line of credit grows regardless of the house value. Non-recourse, and the line of credit cannot be frozen or reduced. So let's go back for just a second. I want to go back to this line of credit. So this illustration, this amortization schedule is calculated on an expected interest rate of 5.8% plus 1.25% back-end mortgage insurance. That's this calculation for this line of credit. I want to throw something out. People say to me, oh, Colleen, interest rates are abnormally low. It's not going to stay this way. Interest rates are going to rise. What happens in this illustration if interest rates go to 8%? Is that a bad thing? Now this line of credit, instead of growing at 5.8 plus 1.25, now it's going to grow at 9.25%. So inflation on this line of credit, on this reverse mortgage, is your friend on the unused portion. Very important to look at that. Next, let's look at this example for supplemental income. Same borrower, 66 years old. His financial situation is exactly the same, but he needs an additional $1,200 a month. That's $14,400. I'm going to give you an example of one of my borrowers. Her name is Kathy. She called me a couple of months ago and she said, Colleen, my financial advisor says that we need to talk to you. We don't want to. We don't want to do a reverse mortgage, but he says we need to talk to you and you just need to explain it to us. Kathy lost her job and she's been collecting unemployment insurance. She's been collecting unemployment. Now, I'm not an expert on unemployment. I don't know how long it lasts, but I do know that when she made the call to me, her unemployment insurance had lapsed. She's done. No more unemployment. So she said to her husband, okay, honey, we're going to take my unemployment, the amount equal to my unemployment benefits from our 401k. He indicates to me in our meeting that their 401k is $60,000. He's 66, she's 62, and the sum total of their investments is a 401k at $60,000. She says, we're going to just take it out of 401k. He says, oh, no, we're not. No, we're not doing that. That's not enough money that we can pull monthly from. She says, okay then, honey. What I'm going to do, what I think we should do, is I'll just take early Social Security. You've all heard that one before. So full retirement age for her is 66. If she takes Social Security at 62, she's going to have a 25%-ish reduction in her full retirement age Social Security benefit. Her husband says, no, honey, we're not doing that one either. Here's what they can do. Here's the amortization schedule for that example. If she took $1,200 a month from a reverse mortgage, and I've only calculated this through 10 years, but what can she do? They can do the reverse mortgage. They can take $1,200 a month now. What happens if changes are in their life? Let's say she gets another job. What happens? $20 fee, stop the monthly payments. Now, no, they're not continuing to pull money, no more interest is accruing. The other thing that she can do is not only stop those monthly payments, but she can start paying back those monthly payments so that money is still available. This has saved their portfolio, which is what I want you to pay attention to. We've now saved their portfolio from this additional drain. We've given them more options because we've added the home equity leg to the stool. Pretty self-explanatory. So let's look at how this works. Our friends at Money Guide Pro have a calculator that will determine the probability of success of this portfolio lasting through these borrowers' lives. If you look at the one on the left, you'll see that if they do nothing but use their green bar, their 25% of their total assets in cash, the probability of success of their money lasting through their lives is 58%. When we add the reverse mortgage and the flexibility designed therein, look what happens to the probability of success. It goes to 96% just by adding the home equity conversion mortgage as one of the buckets that you can pull from depending upon your needs at the time. This is just a waterfall graph. It's not precise to those numbers, but it just illustrates the probability of success in just another format. Here's another one. This example comes from my friend Steve Thomas. We're going back to Steve. His borrowers, his friends, his clients called him and said, Steve, we want to pull another $1,500 a month out of our investments. And I'm sure all of you would have the same reaction. No, not going to happen. So Steve says, let's look at a reverse mortgage. They said, oh, no. We don't want to look at a reverse mortgage. Let's look at what happens in this example by eliminating their monthly payment. It just so happens that the principal and interest on their existing mortgage is almost $1,500, the amount that they're asking for increased income from the portfolio. So we pay off the existing mortgage, and we have a loan balance with the closing costs of $113,000. What do we do with the remaining money? We put it into the line of credit with a growth factor. And I won't belabor this point, but you can see what's going on here. We've preserved the portfolio, and the bottom line of this entire class is to hopefully drive home the point: preserve the cash at all costs. It's more beneficial to use home equity first and investments later. And this example will show you how we've helped this couple, and they are moving forward. And last but not least is HECM for Purchase. HECM for Purchase uses exactly the same calculations that we use in the refinance examples that we've been talking about throughout the presentation. Same calculations, same loan-to-value percentages, but what does it do? We get borrowers who can now purchase a home without having to make payments and make it easier to qualify. And I'm going to give you an example of this before I move forward. I had a little lady whose two daughters live in Denver, and she and her husband lived in rural Utah. And unfortunately, he died, and she was left there, a widow, with her family in Denver. And she was living on Social Security of about $1,100 a month, right around the median Social Security benefit. And she had the nicest house in town, and she sold it for $80,000, which she thought was terrific because in her town it was the nicest house, it was the most expensive house. She took her $80,000 and she says, I'm going to move to Denver so I can be closer to the kids. She has $80,000 and about $1,150 a month in income. How far do you think that took her? She meets with the realtor. The realtor says, you can afford to purchase at about $100,000. We can only qualify you for a mortgage of $20,000. In Denver, Colorado, a $100,000 property still has wheels and axles. It just doesn't exist. I'm talking about manufactured housing. So she was in tears by the time the realtor called me and said, Colleen, I think we need to look at a reverse mortgage for this lady. What we did, we took $72,000 out of her $80,000. We didn't use it all. She purchased a home, a townhouse at $216,000. And what she did at closing is what happens to a lot of people at closing. She cried. She was so happy. She did not have to give up what she had before. She was living in it. She was now buying a very nice townhouse close to the kids. She didn't have to qualify, and she doesn't have to make payments out of that $1,150. Imagine how even making a payment on a $20,000 mortgage exacerbates her financial situation when she only makes $1,150. So now her Social Security is hers. She doesn't have to make a payment, and we didn't use all of her money. So that's HECM for purchase. Here's how it works. I'm going to show you two examples. I'm going to show you a downsizing example and an upsizing example because they happen about equally. We're back with our $500,000 home. Cost of sale $40,000, proceeds $460,000. I'm not going to belabor that. These borrowers want to purchase a home for $350,000. Normally, what would they do? They'd take their $460,000 proceeds, they'd plunk the $350,000 cash down, they'd own the home free and clear, and they would give you $110,000, the extra money. Let's look at a reverse mortgage. Let's see if this makes any sense. Same $500,000, they're still netting $460,000, they're still purchasing at $350,000, but the calculations say that I can bring $190,000 to the table. How much do the borrowers need to bring to the table? The difference, $160,000. I bring $190,000, they bring $160,000. Now what happens? Now these borrowers bring $300,000 to you to add to the portfolio, and they don't have to make a payment on the house. Right? Much better situation for them in the long run. Let's look at an upsizing situation. And it happens all the time. Borrowers want to move into a beautiful 55 plus housing community. Brand new. They've got a golf course, they've got a gym, they've got a clubhouse, there's bridge, there's yoga, all those things. Everything's on one floor, wood floors, granite countertops. It's all top of the line. So these borrowers are going to upsize. Same $460,000 net after the sale of their existing home, but now they're going to buy at $600,000. What normally happens, because they're not going to be able to qualify for a loan, they come to you and they say, Mr. Financial Advisor, we need another $140,000 out of our portfolio, and you do this. You know, it's doubtful. Here's what happens in a reverse for purchase. They still net the same $60,000 on the sale. They're purchasing at $600,000. I'm bringing $340,000 to the table. They only need $260,000. Now what happens is they give you, the financial advisor, $200,000. Look at the swing there. $340,000 swing from the top to the HECM for purchase. $340,000 managed properly is going to extend their retirement income a very long way. Very long way. So the common theme, and we've talked about this a little bit, the common theme, the bottom line to these strategies is that it's pretty straightforward. The reverse mortgage is going to work better when used in planning rather than a product of last resort. And that's from Michael Kitsis, a good partner to us in the reverse mortgage business. So let's just review the strategy. Line of credit with a growth factor. That's my hammer. We looked at how to use this product for supplemental monthly income. We looked at eliminating the monthly payment. And we looked at a HECM for purchase. All right, so let's back up. We've been talking all along, and I've been very careful to say that on a reverse mortgage, no payments are required. I've been very careful to say that. I want to back up to this example of the folks that we were going to eliminate the $1,500 payment. Now, We're going to change their situation a little bit because every borrower is a little bit different, and we customize this for everybody's particular situation. So here we go. Same house value, same existing mortgage balance, but they don't need to get rid of that $1,500 payment. So I'm going to suggest to you, what about we refinance that existing mortgage that they can still make payments on, they're still working, they still have income, they can service that debt. Let's apply that $1,500 to the reverse mortgage. So let's say that every month they go ahead and they make their $1,500 payment to the reverse mortgage. What happens? Take a look at the loan balance column. What will happen is that the loan balance will not increase year after year. That $1,500 will go into the line of credit to increase the line of credit. So I'm going to apply some new math here. $1,500 a month times 12 is $18,000 a year. So now we're increasing that line of credit by $18,000 a year, year after year, plus the growth factor. Look at how that compounds. Are they better off to continue making those traditional mortgage payments where perhaps they're gaining a little bit of equity in the property every month by the fully amortizing loan? We're paying down the principal a little bit. Or are we better off to apply that $1,500 instead of interest and principal on a forward mortgage, apply it to the line of credit? We will soon have a calculator ready for you where you can do exactly that. You can play with the numbers and play with the amount of money that's going to be paid monthly, and it will show you exactly what happens with that line of credit. The power of this is just off the charts. In fact, I don't have a chart for it yet, but we will have one. We'll get it for you. We've talked about my strategies, the line of credit. That, I think, is a useful tool for you to look at for anyone. Who's a good candidate for this? Anybody. Anybody who has a house. And if it's paid for, maybe instead of just leaving that asset, that's 75% of their total assets, leaving it alone, now you apply a line of credit to this that is going to, in 20 years, save their bacon, frankly. We looked at supplemental monthly income. We eliminated monthly payment. We talked about HECM for purchase. Okay, here's some conclusions. We know that FHA has built in plenty of safeguards. We know that you can draw from your housing wealth and protect your investment portfolio, which is the whole purpose of why we're here today. We know that the HECM revolving line of credit has many more protections than a traditional line of credit. We ensure access to your housing wealth in the future, which is why it's more important to do something now than wait until later, because we've given you access to a greater pot of money if we put it there now. Of course, estate wealth is enhanced, and we can withdraw at greater rates from the home equity than possibly you can with the investment portfolio, right? So here is a website. I'm going to stop here for a minute. I want you to write this down. fundinglongevity.com is a website. You'll have to register. You can go on and register, and what you can do now is you can calculate on your own what a reverse mortgage might do for those clients. It'll give you those ideas. It's most likely that when we have the calculator on making payments, that it will probably be embedded in this website. You can also call your local rep, your local reverse mortgage rep, because you're all over the country. You can call me. The important thing is to take a look at it. Whether you do it yourself or call somebody, it's important that you take a look at it. And I want to give a big shout out, a thank you to these economists who didn't accept the conventional wisdom on reverse mortgage as only do it as a product of last resort, save your home equity, save your home equity. These brilliant guys took it upon themselves to say, I think there's some benefit in here, and we really need to do the research. And the research that I presented today is from these gentlemen. There's my information if you need to contact me. And last but not least, I'm leaving you with some discussion topics. And I was very careful when I wrote these discussion topics to make sure that I covered the information throughout the presentation. If you get stumped by one of these, pick up the phone. You can call your local rep, you can call me, but these are really meant to spur some idea sharing amongst yourselves. And I want to thank NAIFA, I want to thank Steve Thomas, and I want to thank you all so much for taking the time to get a better understanding about this product. Have a great day.
Thank you for participating in this program. For more information regarding products, programs, services, and other NAIFA member benefits, visit www.naifa.org.